Thank you for joining us this week for another LinkedIn Live, and we're going to be discussing choosing the best fundraising vehicle for your startup. I am really excited to have someone really special here. I'm thrilled to be joined by Richard Luftig, Managing Partner of Castle Placement. Richard, thanks so much. Full disclosure, Richard is a business partner of mine and CancerU, and I think I now consider him a friend, even though we have never met in person. Richard, tell us a little bit about who you are and what you do.
So I'm a managing partner at Castle Placement. I've been in investment banking my entire career, and Castle Placement was formed in 2009. We're a FINRA licensed investment bank, and we only do one thing, which is raise private equity and debt capital for our clients. It takes an extraordinary amount of resources and time and effort and skill.
So what do you look for when you are selecting startups to work with?
You know, we raise capital for all types of companies. There are many similarities for startups as with a mature company that has $100 million of revenue. And it all starts with the team, because the best business plan in the world and the best opportunity in the world really doesn't mean much at all if you don't have a great team. Experienced, honest, hardworking, you know, all of the attributes that you would want to see when you are entrusting your money to someone else.
What has been your most successful startup to date? And I'll let you define success.
We've had a few that have become extremely successful. One was a reinsurance company called Luftig, and the other is a data archive company called Wasabi. Luftig is a reinsurance company, so they, for the most part, issue fixed annuity policies. And then they take that money and they invest it in primarily fixed income securities. It's now worth hundreds of billions of dollars.
Richard, one of the reasons I brought you on is I want to talk about the ways to fund a startup. There's bootstrapping, there's loans, there's grants, there's family and friends, and then there's angel investors and VCs. So can you just talk about those different paths and your opinion on them?
There's no right or wrong answer. There are great companies that have never raised one penny, terrible companies that have raised enormous amounts of capital. There are many important considerations. One is the amount of equity that you can retain in your company, because there's always a trade-off when you raise capital, because you lose a certain percentage ownership in your company.
Right.
And for debt capital, you have to pay interest and other fees, and that could be a drain on cash flow. So there are always trade-offs. Next thing I would say is the governance of the company. Who gets to make decisions? And as the founder of the company, how much of that do you retain? Because it could be extremely painful for a founder to bring in investors and lose decision-making authority and then have bad decisions made on the company's behalf and suffer or lose everything as a result of those decisions. And then lastly, I would say, you know, who is your financial partner? If it's a crowd of people and they're passive, then that's not a big consideration. But if you take on a VC partner and they do have an active role in the company and or decision-making authority, then that partner is going to be your partner. And like any partner, there could be great things about that vehicle or terrible things. And you're going to have to live with that partner for many years through cycles and twists and turns and ups and downs. So really important to choose your financial partner carefully.
I want to talk about two businesses that we know that raised a tremendous amount of money. One that's completely out of business, the other one being WeWork. So Theranos is in the healthcare space like CancerU, and then of course WeWork is more, I guess, real estate. Both raised a tremendous amount of money. The way the deals were structured, the founder of WeWork Adam, can't think of his last name right now, and Elizabeth Holmes of Theranos, they still retain control. So can you talk a little bit more in the weeds about how you would raise money and yet as a founder still retain the majority decision-making power?
Like everything else, raising capital is about supply and demand. If you commence a capital raise and you get very little interest and you are desperate for the capital and one investor shows up, then your leverage or negotiating power is de minimis. You may have to agree to a very low valuation. You may have to agree to give up decision-making authority. On the other side of that spectrum, if you are in significant demand and there are many investors that are interested in deploying capital in your company, then you can be a stronger negotiator with respect to the essential components like valuation and governance.
I have another question about timelines. I'll use an example of Mirror, bought by Lululemon for $500 million, if I'm not mistaken. I know when she was raising money for Mirror, the founder, she had this very technical hardware product, this mirror that people could actually look into, right, and see others while exercising. And she spent a year and a half raising money before she ever developed the tech, which took another year and a half. So how long does it take the average company to raise money? And does it really depend on the space they're in?
How they're raising the capital, what method they're using. Are they doing it by themselves or have they hired an investment bank? If they've hired an investment bank, is it a good investment bank or a not good investment bank? Common sense factors. How much growth has the company experienced? How great is the management team? What is their track record? How big is the opportunity? How scalable is it? The more positive each of those components are, the faster and the easier the capital raise. If the founder is weak on one or more of those points, it could take a very long time. It could be unsuccessful altogether. 2 months to a year would be a typical range. And that's a really long range. It should be a really long range. Every company and capital raise is idiosyncratic, and depending on what the company has to offer and what resources they have towards doing the capital raise is going to very much impact the timeline. You could be a fantastic company, but if you put an extremely aggressive valuation on that company, it could take infinite to raise capital. The market might just say your perception of valuation is unrealistic and we're not interested.
Let's talk about market for a second. So for your companies, did COVID-19 have any impact on their fundraising? I mean, did you see anything happen?
You have to put that in the context of what's going on in the private equity and venture capital world. That is a challenge for many companies. If someone was in the restaurant business or the hotel business, their businesses were severely challenged during the COVID period, probably a really difficult time to be raising capital. On the flip side of that, if you were in e-commerce or logistics, the money was flowing. Everyone wanted to deploy capital in businesses that they thought would do well during the crisis and after the crisis. Many investors recognized that the world was going to change as a result of the pandemic, and even post-pandemic, certain types of companies would thrive. It's a very efficient shift of capital from January 2020 until now. The amount of capital sloshing around the system increased dramatically. The supply of money and the demand of money determines whether a capital raise is successful.
I have a question related to the market, related to e-commerce. Food delivery skyrocketed, right, during the pandemic. These food delivery services, except for one during one quarter, are not profitable. For many analysts, they're not on a path to profitability. In your opinion, what's more important, revenue or profit?
Clearly, many other analysts do believe that they're on a path to profitability. Otherwise, they would not have received so much capital. It's really tough. It's a really tough question. I can tell you for sure that right now, the market seems much more focused on revenue. Always important. Everyone talks about the path to profitability and tries to map out when the company will become profitable. For many investors and many early stage companies, there's a much more intense focus on revenue. If you don't find your customer and you don't generate revenue, there's a 100% probability that you won't be profitable. Generate revenue, that revenue is growing, one can make the argument that you'll be able to find that path to profitability. Certainly not always the case. People don't realize how complex investing is. You gave a terrific example, food delivery services. You can sit there in January of 2020 and say, no brainer, pandemic, food delivery services are going to be really successful. You might even say post-pandemic, people's lifestyles and perceptions and habits are going to change. So
Sure.
food delivery will continue to be extremely successful. And you could be exactly right about that. But that doesn't mean that any particular food delivery company is going to be successful. Yeah, it's not just about the industry trends and the macro. It's also about the management team and innovation and ability to pivot. Investing is really tough.
I'm going to talk about one of your favorite fundraising vehicles. What is a Reg CF, so cat frog, and why would startups use Reg CF as a capital raise?
Reg CF is a child of the Jobs Act enacted during the Obama administration. It's a way for companies to obtain capital from non-accredited investors, which just means regular people who aren't necessarily very rich, don't necessarily make a gigantic salary, but want to invest $500, $1,000, $2,000 in a company. The U.S. government decided that small companies generate jobs. For small companies to get started and grow and thrive, they need capital. So the government made it really easy for small companies to raise capital from non-wealthy people and non-institutional people.
So how is WeFunder, Start Engine, how are they different from, let's say, a Kickstarter or Indiegogo?
It's very simple. Those are all crowdfunding sites. Start Engine is an equity crowdfunding site.
Got it.
Kickstarter is not an equity crowdfunding site. So when someone gives their money to a company on Kickstarter, they're not getting an ownership interest or any type of profit participation or revenue participation in the company. They're doing it because they believe in the company and they want to do a good thing. And maybe they get a t-shirt or a mug or move up on the waiting list to buy the company's product, but they don't get ownership in the company. In Reg CF equity crowdfunding, when the person wires that money in or gives their credit card, they get ownership in the company.
Which companies do you think are good candidates for a Reg CF and why?
I would say that there are two main determinants. One, it's better, not necessary, but better if the company has a passionate following, customer base, a fan base. For instance, solar energy company. There are many people that are passionate about the environment and alternative energy and might be inclined to invest in a solar energy company. Another example could be like a beverage company where they have thousands of customers who just love that product and want to be an owner of the company. The second is it takes money. You have to pay a lawyer, you have to pay an accountant, pay for digital advertising. Many startups just don't have the resources to fund the crowdfunding transaction.
So we do have a comment, I don't know if it's a question or a comment from Christopher Hedrick, hope I'm pronouncing that right. Reg CF versus traditional VC. I don't know what the question is, that's what he put.
Oh no, I think I know what the question is.
Okay, go ahead.
There are many huge differences between taking capital from a VC or doing a Reg CF capital raise.
Okay.
But I guess what I would highlight is one, valuation. Generally speaking, and this is only a generalization, companies can usually achieve a more aggressive valuation in a Reg CF than they can from a VC. And the second is your life after the investment round closes. Reg CF investors are passive investors, so they don't have a vote on decision making at the company, don't have much communication with the company. The company is required to send them financial information twice a year. But other than that, it's an extremely low burden. A VC investor could be, extraordinarily intrusive. And that could be really bad or it could be really great. They could destroy your company and make your life terrible. If the VC is nice and smart and honest, they could add enormous value to your company. So like everything else in life, it's trade-offs.
You and I met sort of on LinkedIn where I saw you, I think it was a LinkedIn Live with Shay Rowbottom. Shout out to Shay. And I heard you talking about Castle Placement, and then I sent a message to you, and that got the ball rolling. So my question now is, why did you decide to partner with CancerU?
Extraordinarily easy decision. One, it's just a great platform helping so many people who really, really need help. Investment banking is a pretty dry, boring, capitalistic endeavor. So when you have the opportunity to do something that's good, that is a huge fringe benefit. The second is, I think Cancer University is just an incredible idea. I think it's going to be a very profitable company. It provides such a valuable service, extremely scalable, because unfortunately, there are no shortage of people that are suffering from cancer.
Yeah.
And no shortage of family members of people suffering from cancer and caregivers for cancer patients. So the need is enormous. And then the third, and you may have to close your ears because I don't want you to have a big ego, but
I didn't tell him to say anything.
but you're a dynamo, and that's a really important part of how we think about clients, only because that's how investors think about clients. You're ambitious, but also this is not just about money. This is embedded in your soul, something that you want to do for the world, and no one's going to stop you.
Well, thank you so much. I really did not tell him to say that. We are very fortunate to be partnered with Castle Placement, and they have just been our biggest cheerleaders. Can you tell people about your clubhouse a little bit?
Yeah, we have a clubhouse room every Wednesday night at 7 p.m. and it's extremely unique. The companies that present who are seeking to raise capital and come onto our show are great companies, because Castle Placement only will work with great companies. Not to demean any other platform or any other type of pitch show, you're often listening to folks who have no business presenting or raising capital. They haven't really thought through their business plan. They don't have any traction. They don't have a track record. So that's the first big difference. We have great companies presenting. The second is that we have real investors who ask questions, analyze the company, and most importantly, can invest in the company, because we are a FINRA licensed broker-dealer, and these are live transactions on our platform. Well, many of them are. Some of them are just people that come to the room and want to present. But many of the companies are actually live. And then lastly, we talk about really interesting topics in the investment banking, capital markets, entrepreneurship, and I think people really like that.
Yeah, and I just want to do a shout out. So if people just look for look for Castle Placement on Clubhouse, they'll find it, correct?
Yes, it's called Capital Raised.
Capital Raised.
It's called CP Go Capital Raised.
Okay, so look for that on Clubhouse, and I want to say, not because I've been able to present twice, but because I've been in a lot of other clubs and rooms. It is one of the most well-moderated rooms I've ever been in. I've been in some rooms that say that they have this purpose, they're going to allow people on stage, and it's 15 moderators, and all they do is chit-chat the whole time. So it's nothing like that. It's an excellent
Thank you.
room to be in. Oh yeah, you know I love it. And before we wrap things up, we do have another question. Reg A versus Reg D. I'm not even sure I know the difference. So could you answer that question?
Sure. So the three primary ways that we raise capital, and they're probably the three primary ways that capital is raised: private capital, public, IPO, it's a whole different conversation. But the three primary ways for private are Reg CF, Reg A, and Reg D. Reg CF is equity crowdfunding up to $5 million. And the process is very quick and inexpensive. Reg A is also equity crowdfunding. So you're going after the same exact investors, but you can raise up to $75 million per year. So Reg CF, $5 million per year. Wow. Reg A, $75 million per year. With that, though, Reg A has a much more difficult process that the company has to go through to launch the deal. It's a significant amount of information has to be provided to the SEC, and the SEC asks several questions, and there are rounds of information requests and questions, and it can take upwards of 9 to 12 months and be very expensive. But once you're through that, again, you could raise $75 million per year, so it's very exciting. And then Reg D 506C is you can call it institutional or accredited investor capital raising.
Okay.
So it's extremely cheap to go out and do a Reg D 506C, and the regulatory burden for the issuer is de minimis. But you're limited to raising capital from institutional investors like PE, VC, family offices, sovereign wealth funds, pension funds, insurance companies, etc., or accredited investors, which are people who have a certain net worth and a certain salary.
Okay. All right. So I think I have the difference. So yeah, I'm not even going to try to repeat that back. People, if you just watch it again, I kind of know the difference, but not to that deep level. We're going to lose Richard here in a few minutes. If you have any more comments, put them in the chat. And be sure, if you want to reach out to Richard, go to castleplacement.com, or if you see the little scrolling at the bottom, you can see his email. It's basically his name, rluftig@castleplacement.com. And Richard, do you have anything to add before we wrap up? And I'll check one more time for comments.
Nothing to add. This was a super interesting conversation. I really, really enjoyed it, and I really appreciate you having me on the show.
Well, thank you so much for coming. Even though I guess we had some technical difficulties at the beginning, people couldn't hear us, but they can now. Again, please reach out to Richard if you're a startup and you need help raising money. He's been just a tremendous partner by our side, as well as his partner, Ken. And join me next week. I think most of you know I talk about healthcare, cancer, business, and writing. So next week, I'm going to be talking about 10 writing do's and don'ts when you are publishing your book. So we'll talk to you next week.